Opportunities we have here going into our afternoon. There's a couple really amazing things that have gone on here over the last couple of weeks, and there's nothing new here with the dollar strength trade. We've been coming out of this monthly long setup since January. We know that going into the autumn of this year is the most dangerous time of the 4-year cycle of the credit cycle of the Fed's long and variable lag that exists after they announce the beginning of rate cuts, which is counterintuitive and what really trips up a lot of retail traders. Historically speaking, they chase the all-time highs. They chase SpaceX. They chase the tech bubble. They chase the end of the housing boom. They chase, fill in the blank. But there's some huge signs inside of our markets that this is one of the greatest moments of financial risk that we've had in the last 4 years. And there's no way to sugarcoat that. There is a massive dollar long setup that's developing here, and we're going straight up in extensions. So that's the first thing. For newcomers here, dollar up, down, indices down. When there's a negative correlation, and we do have a negative correlation. We have bank breaking through its series of longs. When bank is rising, the indices rise. When bank is falling, the indices fall. So here's our second leading indicator. And then we have the VIX falling into its first full pullback after a trend break. Now, it has been front run by 4 ticks. And this is the one little gotcha that I think that we still have yet this week, in that the VIX will fall into these targets of its opposing short setup, and Wall Street will get its fill on a Tuesday, Wednesday, Thursday. And that is still a real possibility as we're moving forward. Usually when we're coming back to the very first day after a holiday or coming back from a weekend, that's not the top of the market. That's not the bottom of the market. Wall Street always gets its fill. And so there's a small question about the sequence of events here, which is important. And right now, all that we know is that the VIX has been up and is higher above the 1810s. And that creates weakness in the intraday for the indices. Now, should we break those 1810s? And actually, it's 1814 rounding down to 10 and adding a tick. It's actually 1805. Should we break the 1805, well, the indices are going to make another squeeze back up into their previous highs. But above those 1810s, the indices go down from where they are. The dollar right now inside of that extension says the indices go down from where they were this morning. The VIX above the 1805 tells us the indices go down from where they are. Why is this so important? Why is this all so important? Because for 9 weeks, the S&P 500 was essentially going straight up. It was going straight up. And what everyone was talking about, 9 consecutive weeks of gains on the S&P 500 here, if you looked at only that number, you would just think, oh, the market's on fire. You're missing it. You have to buy the S&P 500. The Kramer, do it for your kids and grandkids. Well, while the index was climbing, 53% of the stocks inside of the S&P 500 were falling. Last week, as of Thursday, for 6 days in a row, more stocks inside of the S&P 500 were going down than were going up. And so while the index itself was going up for 6 consecutive sessions, before this month, that had never happened before. Not once. Not in 30 years of data going back to 1996. The previous record was 3 days. So we just doubled it. The first thing to understand, this stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.